Hi, everyone. I'm Rick Bensignor. Today is Tuesday, February 9th, and welcome to this week's In the Know Trader Show. Well, we've got up on our agenda today in our trader education portion, we're going to talk about being wary of those in this business who actually believe their own hype, something we've reflected upon before, but I think an important enough subject to hit you up on again. In our market overview section, we'll take a look at the Russell 2000 that has been storming to new highs, the US 10-year, and then the ETF that best tracks the gold market, GLD. And then as far as taking a look at a group each week, I've put together a list of possible short squeeze candidates considering what went on over the last couple of weeks in GameStop and AMC and costs and lots of other names that got squeezed. A good friend of mine on the street who works for a sell-side firm came up with this. So we're going to look at a bunch of names that tend to focus kind of in the financial and insurance space. Not every one of these, but these are, his list of possible short squeeze candidates. So we'll take a look at them and see if we can see anything on the charts that give us a clue on how to play them and when it may be worth buying if you're going to look to play that game of squeezing the institutions and hedge funds that are, and usually it's hedge funds as compared to just outright buy-side institutions, but it's usually the hedge fund sides who are short stocks, and see if there's anything here that makes sense to do. So that's what we'll take a look at. As far as me just doing a quick marketing of myself and the products we have, of course, we have the weekly ETF Tactical Trader Report from In the Know Trader that comes out Wednesday nights. Reviews markets, gives you a new ETF trading idea every week and updates all open positions until they are closed out. And you can get information for that at intheknowtrader.com, as well as our 7-Eleven monthly spider sector report, which I put together starting last August. And the goal there is to beat the S&P each year. We, as of January 31st, we were up 1.9% over the S&P since we started last August. So that annualizes out to just over 4% or so beat. And for those of you who want to do better than the spider, and you're okay on doing some very minimal tweaking of actively managing some ETFs, that's the way to go instead of just sticking with a spider. And that comes out monthly at generally the last day of the month is when I'll put out that report. So you have everything you need to in order to make any necessary changes the morning that opens up the new quarter, the new month. Okay, so let's go back here and talk about this subject that, again, I have spoken about before, but I want to kind of hit upon it in a slightly different way. I've talked to you before about people who do incessant marketing in this business, and advertise on Facebook and the like, and just keep pounding you with why there's such great reasons that you should subscribe to their service or listen to their stock calls, etc. So let's kind of just again start this off with be wary of those who actually believe their own BS. And the reality is there are a ton of people who put out calls in the market, more than you can possibly imagine. And I think it's your goal and responsibility to kind of weed through the mess out there to find the few people who consistently get this right. And because, look, this playing the market, especially if you're more on the short-term tactical side and, kind of trading and not just simply investing and putting money away for the 10, 20, 30, and 40 years, but you kind of have some sense of liking to be in and out at opportune times for at least the trading portion of your total portfolio, is to be wary of those people who come across as being cocky in their emails and advertising, those who seem to know it all and have that attitude like they do, that they're boisterous. They virtually assure you of success. They tend to have some arrogance in the way they come across, as if they know better than anybody else, and you should listen to me because I'm the one who's going to give you the answers that you need to your riches. Generally, all you're doing is making that person rich by subscribing to them, and you're not going to truly outperform or do anything better than you could have on your own. Uh, I've recently seen some people who actually throw expletives inside their marketing, um, as if, again, there's this really cocky attitude, and they'll actually use curse words in there, like "I don't give a," we'll say X, um, and other things, as if because it's all about their wonderful ways of telling you what to do in the market. Um, and these people can show up on any platform, from the most respectable to the least ones, because a lot of these platforms have lots of contributors. They tend to over market themselves in the sense that, constantly getting barraged by them, either with daily emails or anything that just keeps them in front of you daily. And the reality is, you don't need somebody in front of you daily. That is all part of a marketing scheme. And some of these people are terrific marketers. Um, and I give them credit for being terrific marketers. I don't necessarily give them credit at all for making you more money than you could have on your own or by listening to somebody else. Um, they often tend to actually believe that they have the absolute best product out there, and they'll kind of remind you of that too. That, you know that their product is better than anything else out there. Um, they often make claims of being complete experts in the industry, and they might have 10 years of industry experience, some 15 or 20 years. Doesn't matter. Yeah, they're generally not using anything that you can't do yourself and learn in a few months and practice yourselves. So, um, it just tends to be a ton of hype. They'll often talk about deep institutional contacts, and yet they don't really have them. Um, so I think that's kind of the point. And again, I've made this before, and I'm not going to harp on it anymore in this week's episode. Um, just generally be wary of those who believe their own hype, because they think their resume is incredible and that nobody else has the expertise they do. And that's not who you should be looking for to help get guidance in the market. You generally want to find people who, they don't necessarily have to be as popular, and they are people who you have either seen speak at a conference or in a webinar or something, where you get the good sense inside of you that this person has the right intentions, and they're really there to help you make money. And it's not about them having their own business and making money. It's about them truly. It's about, like, think of it in this term. It's about them being a giver so that you get the information and the consistent information you need to get ahead, as compared to them actually being the taker who's simply trying to get more and more people to subscribe to their product, and don't necessarily have the intentions right here of helping you, but them themselves, just making more money. So that's what I'm going to talk about. And that's the conclusion of today's little trader education portion. Let's now move back to, we're going to jump ahead here. And as we always do, as we start looking at the markets, we're going to start with just kind of looking at how the sectors are doing this year. So on the very far left is the return of the S&P through last night. So for the year, yes, the spiders, not the S&P cash, but the actual spiders, which are usually going to outperform because they collect dividends, whereas the S&P is a pure index. is up 4.45%. So anything that's up more than 4.45% has outperformed the S&P so far. Clearly, energy, the huge winner this year, up virtually 17% on the year. And that's the place to have been for the last few months, certainly. Um, as I've said before, realize that the S&P energy sector is no more than 3% of the total S&P. So if you hadn't partaken in this, you're not necessarily trailing, because it is such a small piece of the S&P. But on a pure, spider sector basis, clearly energy is the big winner after 2 years of being the biggest loser, both in 2020 and 2019. Finally, we've seen energy get a good bid, and a large part of that is because crude oil is trading at $58 a barrel. Whereas you'll recall I think it was April, when crude oil actually traded negative prices in the front month futures contract. And so energy's finally come back, ferociously, and is the big winner. And often a lot of the trends that you'll see at the beginning of the year, especially on something like this, where it was the loser for 2 years in a row, tends to stick over the course of the year. And it doesn't mean energy has to outperform hugely, but my guess is that if as long as oil stays above, I don't know, let's call it $40, give or take, energy is going to be a place this year that's certainly going to continue to see some bid, and at some point it'll pull back, and probably won't outperform this much, but you've certainly seen a rotation even back into the more old economy type of energy names. The Exxons and Chevrons, et cetera, have had good runs too, besides some of the other names. So energy, the best performer of the year. Consumer discretionary, second best at 7.73%. So, that's outperformed by over 300 basis points, and then so on. The one sector that's actually down on the year is consumer staples. I guess intuitively makes some sense that it's certainly trailing the S&P. The fact that it's down shows just how bad it is, because even in a year that the S&P is up over 4%, you actually have negative return with staples. And you can see that on the right hand, half of this bar chart, you tend to get a little more of the cyclical part of the market. So healthcare is underperforming, utilities underperforming, financials are actually outperforming. Of course, interest rates have moved up, so I'd expect that to continue. I actually, financials is my favorite important cyclical sector. I don't consider energy such an important sector, just simply because it's such a small percent of the S&P. So even though it's up on outright terms, and you'd make 17% or so this year, it's still only 3%. But to me, financials is the key sector for this year. I do think interest rates continue higher, and that is a place that we are overweight, and I continue to think that we'll get decent performance out of financials this year. All righty, let's go back and let's take a look here. So IWM, TNX, and GLD. So let's get to our charts. Give me one sec. Got to just make an adjustment on something. Here we go. Okay, so let's find our charts. And here we go. So IWM. Here's a weekly chart of the Russell 2000 tracking ETF. You can see this is on all-time highs. It's thrusting higher and has been. And if we were to look at small caps versus large caps, or small caps even versus mid caps, or let's even better said QQQs, they have been surging, and you can see, at least on this chart, it appears as if there's no end in sight. We've blown through these older propulsion full exhaustion levels. It looks like nothing's much ahead of us. And when that occurs, you've got to come up with some ways of looking at possible targets or exhaustion before something, makes a top and then starts selling off. You want to have kind of a sense of where those tops may be, both from a trading perspective and a timing perspective. So let's look at what we have here before I change the time frame on this, maybe to a monthly chart to see if something else shows up. So we gapped higher again this week. I do see we're on a aggressive sequential 12 count this week, which likely puts next week, unless we get a decent sell off. Next week will be a 13 count. We know that 13s often are a point that buying within a trend increases the risk. So that's one thing, at least I kind of know. We're on a classic standard sequential 10 count. So that says, we're 3 weeks away from a potential top. So gives me some clue that perhaps, again, we're late in a rally. Let's look at this on a monthly basis and see what I see. And I think this gives me also some important information. So I look at some other prior 13s and 9s. I see some peaks. And then again, there's a monthly chart. So let's say the 13 in here gives you a 3-month top. This one gets you awfully close to almost a year-long top back in 2015. Here we have, a top that was the top for, we didn't exceed that for 2.5 years. So we're on an 8 count now, a setup 8, which means next month is a 9. We know that certain 9 counts also part of this model. Turn markets is a 9 bottom, this is a 9 high. This 9 didn't do anything, and we kept going all the way up to the 13. But I know that we're going to have a 9 count next month with an upside target of just about 235. And that's just a little above where we are. So that also says to me we're reaching some targets, and this is target. So in the IWM, roughly the 235 level is a predicted target off of last April's low or March's low, right? So if March 23rd made the low for the markets, the spring off of that suggests that the physics of the market measure out to 235-ish. And the fact that we're getting close to that on an 8 count with the type, look at the acceleration we've seen in the last several months, makes me think we're getting, sometime in February or March, could even extend into April, but somewhere not a heck of a lot higher than where we are, could be all this goes before it consolidates. It could pull back, doesn't mean it has to have a big pullback. But if you think of trend in terms of there's 3 trends in the market, there's an uptrend, there's a downtrend, and then there's sideways. Because there are 3 distinct trends, not just up or down, if you've been going higher and then you stop going higher, that's a change in trend. So in other words, an uptrend that then consolidates and goes sideways is a trend change. You don't have to go lower. You just have to stop doing the trend that had been prevalent at the time. And given this incredible thrust that we've seen, it makes me think also at some point, coming up first quarter, very early second quarter, I'll probably start hedging, but both making recommendations to clients to hedge and hedging my own book of the portfolio I have myself of my own investments, because it would suggest that from a timing perspective and a physics perspective, these are kind of lining up to suggest that this may be a very good time sometime in the next few months to rein things in. So that's what I see in the IWM. Let's look at the TNX, the US 10-year, and let's just look at a basic. Here's just a basic daily chart. This zone up in here represents the old highs and lows that had been, if we look at long-term charts, kind of what had been previous as all-time lows. So I generally have been telling people 1.4% plus or minus 10 basis points or so, is the main zone of where all the breakdown came from last year. And, on a short-term basis, there's still this gap just under 1%. That's a decent sized gap that hasn't been filled. So if we do pull back and break under that double bottom we had at 1%, I'd look for the gap to be filled and then kind of test this whole consolidation place in here. and this should be decent support. So I don't think rates take a big dive, but they certainly could just get short-term type pullback. In general, though, I still think it's going higher. Let's take a look at this on a weekly basis. And again, if I look back to 2016 and I go even farther back to 2000, I think it was 2012. Yeah, I mean, so if I just draw a basic, oops, move 10, just a straight line across, you can see that this purple line is kind of where the old highs have been. I'm sorry, the old lows, right? So we had a double or even triple bottom around there. So that's why, we're starting to get closer up to that level. Um, I actually think something that we could surprise on the upside and later this year, even get, north of 1.8% and kind of test the highs back that we saw in late 2019. Again, these are in yield terms. So I'm not a big fan of the bond market. Um, I do think the lows that we saw down near 50 basis points, are the secular lows for the U.S. and that's where we're not going into a negative and 0% environment out on the curve like many other people thought. So we've been playing this, and again, I can tell you I am overweight financials because I do think the rising interest rates are good for the financial stocks, and it is at least showing up over the last few months that they are a place to be, not just on an outright basis, but an overweight basis. And then let's find, did I do a GLD chart? Let's see. GCA, I guess not. All right, so let me add, here, just take this in for a second. We're going to duplicate this chart and then we'll switch it to GLD on a weekly. Okay, and let's put up a cloud because I know, yeah. So here's gold. Gold peaked last August, and GLD is going to very closely track the increase and decrease on a percentage basis of the price of gold each day. And what's important is we at least have some semblance possibly of a double bottom, but realize very clearly, and I'm going to draw this view kind of, here, I guess we'll do this to this and this in here. There is a fairly clear downward channel that gold has been in since it peaked. And again, we've got the chance for double bottom that's maybe in place. Way too early to tell, but the trend's been straight down since August. What to me is really important is take a look at the bottom of the weekly cloud. That's at let's call it just about where is that 165 or so for several months going forward. That's going to be pretty important to me because it's very similar to where this low was here, 165 and change. And if you look at the cloud chart, since gold really broke out in 2019 and finally broke a 7-year sideways pattern, the top of the cloud was the low of the move. And now you see that still the top of the cloud is kind of where we're getting some support. I can live with it getting to the bottom of the cloud. I don't really want to see it get much lower than this. So maybe this is all a big kind of consolidation phase that takes out a whole bunch of longs who end up taking some profit and shorts pay up before gold can break out to the upside. I think the long-term fundamentals are still favorable for gold. Everything that I know about gold and the contacts I have who are in the gold industry tell me the fundamentals are good. And heck, if you look like Bitcoin's doing, if you think there's any sense that gold and Bitcoin can at least generally go towards the same direction, I'm not talking about percent returns, but that alternative assets are are a place to be, then hopefully this resolves itself to the upside. So I'm still holding gold for myself. I have some clients in gold. And we're kind of living through. We took some profits in here near 180, but I'm trying to stick with this, hoping that the long term prospects are still on the upside. All right, so that's that. And now let's get to some of these short squeeze names that I mentioned, that a friend of mine over at a company called BTIG put together. Um, let's see. Let's start with Aon. We'll blow this up. Okay. So first off, here's a weekly chart of Aon Corp, one of the names that shows up on their list. And to me, this looks like this is a tough idea to think of as a short squeeze because it's virtually on all-time highs. Um, so maybe it certainly must have a high short interest to it, and that's why it's on their list. But if I'm going to buy one of these type names, I basically want to see a stock that's been beaten down. And even though last week it had this huge up move, and look, maybe it is part of some short squeeze, but yeah, you've got to break out above all these tops in here. So that's good. Um, but right away, looking at this is not going to be the type stock that I'm going to want to put money into for that short squeeze type play. I want kind of cheaper price stocks where I can buy more shares. And B, I want to buy something that, if we were down in here or something and you say, all right, this is a short squeeze candidate and it's gotten its rear end handed to it, I can go for it more. Something that is very close to its all-time highs doesn't fit into the mode of what I think. So for me, it's not even something I'd consider. Let's take a look at Franklin Resources, Ben. All right, so at least we're looking at a weekly chart for the last few years. It's gotten beaten up. It's finally starting to build. It does have a near-term 13.9 against the TDST level. That's why we've at least had the pause. You are getting some initial cloud conversion line support over the last couple of weeks. This, to me, probably if you got above 28 and a half, it's trading 26 and a half. That may have some room to go on the upside. So that's one. And if I was going to buy it and it pulled back, I'd probably look for 23 and a half-ish or something as a place to think about. Invesco. This I actually, unfortunately, own myself. And I'm still not even. I'm getting a lot closer to it. This I like in the sense that at least you have a cloud breakout over the last 5-6 weeks. And again, you're staring at a 13. This has huge upside momentum from the MACD. If I was going to be a buyer, I'd probably think somewhere near what is that, 19ish, give or take, or something, and look, for again, if this is going to squeeze, I'd wait for a little pullback on it. Eaton Vance, another money manager firm, basically on all-time highs. Why, short squeeze? Well, maybe it happened back in here or whatever last year. But, and I think if I remember, Morgan Stanley, I think, bought Eaton Vance. It somehow rings a bell. Maybe that was earnings or the announcement. I'm not sure, but I'm not buying something up here. So not good for me in that short squeeze type play. This one also, SC, Santander, not interested in. We may not find many here. This had a huge squeeze. All right, so here, this consolidation, I can draw a trend line. This is credit acceptance, CACC. So if I were to, let's see where our trend line shows up relative. I'll pull back here. All right, so, oops. All right, so we're above the trend. I don't know. I'd say, maybe in here, this may be worth it. But again, you're talking about $350 a share. Those are not the type of names that I am looking to play on these short squeeze. I really want to kind of find, low price stock. And we'll do one more. Goosehead Insurance. Nope, all-time highs. So I don't know if that was helpful or not. Again, I'm going off of somebody else's list. But if you're going to play this short squeeze game, I would really go and try to find the low price stocks. Find your levels to play off of. Use sell stops that have a little bit more room than normal. But that's the way I would approach this. And I hope you enjoyed this week's show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.